Time value of money. Welcome to MBA in a Can, where we simplify essential business concepts into clear and practical insights. In this financial management series, we're diving into the fundamentals of how businesses handle money, make investment decisions, and evaluate performance. Money, risk, and the way the financial system works can seem complicated at first glance. It's not unusual to wrestle with these concepts before they start to make sense. One of the foundational ideas in finance is the time value of money, a principle that helps explain why a dollar today is worth more than a dollar in the future. At its simplest, it's the idea that money available now can be put to work, earning more money, while money received later can't start growing until you have it. Think of it this way: if someone offers you $100 today or $100 a year from now, most people instinctively choose the $100 now. Why? Because if you have it today, you could invest it, save it, or use it to pay off debt, making it more valuable than waiting for the same amount later. This ability of money to grow over time is why timing matters in financial decisions. To understand this, let's start with interest. Interest is the cost of borrowing money or the return on investing it. If you invest $100 at an annual interest rate of 5%, after 1 year, you'll have $105. That extra $5 is the interest earned. It's the reward for letting your money work for you over time. The idea of earning interest is what makes money today more valuable than money in the future. Now, let's talk about two important concepts tied to the time value of money: future value and present value. Future value asks, if I invest this money today, how much will it grow to in the future? For example, if you invest $1,000 at a 6% interest rate, its future value after 1 year is $1,060. Present value flips the question: how much is a future amount of money worth today? If you know you'll receive $1,060 in a year, its present value at a 6% interest rate is $1,000 today. This is because $1,000 today could be invested to grow into $1,060 over that year. To connect this back to the real world, think about borrowing and lending. When you borrow money, you're essentially borrowing against its future value. The lender expects interest as compensation for giving you money today rather than holding on to it. This dynamic is at the heart of loans, mortgages, and credit cards, and it's why paying interest on debt costs you money over time. Another key part of this concept is discounting, which helps adjust future money to its value today. Imagine you're deciding whether to accept $10,000 in 5 years or a smaller amount today. Discounting helps you calculate how much that future $10,000 is worth now, factoring in an interest rate. This idea is especially useful for businesses evaluating investment opportunities. For example, a company might assess the present value of expected cash flows from a new project to decide if the investment is worthwhile. The time value of money also accounts for risk. Money promised in the future carries uncertainty. Will the borrower repay it? Will inflation reduce its buying power? Will unforeseen events affect its value? All these risks make money today more certain and, therefore, more valuable. To put it in perspective, consider this analogy: money is like a seed. A seed planted today can grow into a tree, yielding fruit over time. The longer you wait to plant the seed, the more you delay its growth. The time value of money captures this idea, emphasizing the importance of putting money to work as soon as possible. Understanding the time value of money takes time, but it's a critical building block for making better financial decisions. Whether you're deciding to save, invest, or take on debt, grasping this principle helps you see the true value of money over time. For more on financial management, explore our videos on capital budgeting, financial statements, and key financial ratios. Thanks for watching MBA in a Can. If you found this helpful, please like, subscribe, and share it with your friends and colleagues. Check the description for links to useful sources on the topic. See you in the next video.